Hey everyone, thanks so much for joining our webinar. We're going to get started in about 2 minutes. We're just waiting for folks to hop on in. I'm going to ask folks to please post in the chat where you are zooming in from and what type of business you have. And I'm going to repeat that because we have so many people flowing in. So if you are here for the Collective Times Squarespace webinar on lowering your tax bill, you're in the right place. We're going to get started in about 1 minute. I would love to hear from all of you in the chat where you are zooming in from and what type of business you have. All right, so we have, I gotta move this little guy. We have Orency from South Florida is a freelance graphic designer. Awesome. And T is from Wisconsin and is a website designer. Given that we're partnering with Squarespace, I have a feeling we're going to have a lot of overlap in the types of businesses that we have here. So Chelsea from Northern Colorado is another website designer. I love doing webinars for folks who are all in the same industry and field. It makes it so much easier for me to give like context and examples. Angela is from Maryland, heart-centered brand and website designer. I love that. Andrea from Portland, Oregon, copywriting, communication, and marketing consulting. Love that. Kristen from Eugene, Oregon, licensed contractor, interior designer, and construction. Wow, that's so many skill sets. HR from Vashon Island, website and book designer. And Sherry, virtual assistant for designers with a background in architecture in North Carolina. Thank you so much all for posting in the chat. It's 2 minutes past the hour, so we are going to get started because we have a lot of stuff to cover. So with that, I'm actually going to hand it over to Sam from Squarespace, who's going to say a few words, and then we're going to talk all about taxes.
Thanks, Andy. I just wanted to welcome everybody. Hello, I'm seeing some familiar faces in the chat. It's great to see people out here just trying to get more education on building and strengthening their businesses. And we are just delighted to start off this partnership with Collective really strong. I know that you're going to see a lot of ways in which both Collective, but also the knowledge that you gain here today is going to build out and strengthen any kind of businesses. So a lot of variety of businesses here today, and just delighted to see what Collective is going to bring to help you all out. I'll hand it back over to Andy and looking forward to hearing more.
Awesome. Thanks so much, Sam. So Sam mentioned, my name is Andy Smiles. I am the Director of Customer and Product Marketing here at Collective. I'm also a former solopreneur myself, so I've been on both sides of the coin. Okay, I just got to get all the screens together. Let's talk about what we're going to talk about. So we are going to start off today discussing self-employed taxes 101. We're going to give you a very strong foundation of how you're currently taxed. Then we're going to talk all about S Corps. We're going to talk about how S Corps can help you lower your tax bill and how Collective can make it easy for you to own and operate your own S Corp. And then we're going to have a live Q&A at the end. On the live Q&A, please put your questions in the Q&A box and not the chat. You all are free to chatter away in the chat. I love like community engagement with each other, but it's really difficult to track questions in the chat. So if you could please put your questions in the Q&A, that will ensure I will answer them at the end because I can check off the ones that I have and haven't answered. And before we really jump in, I want to share a quick note from our legal team. This webinar is for educational purposes only. Nothing in this webinar should be viewed as legal or tax advice. Always consider consulting a professional if you need specific legal and tax advice for your business. Now, I mentioned that I'm from Collective. Sam has mentioned Collective as well. You might be wondering, what is Collective? So Collective is the first all-in-one online financial platform designed for self-employed people. What does that really mean? Well, this is your money when you're self-employed. Basically, there's a lot of stuff to keep up with. You have to do your bookkeeping, your taxes. You got to figure out how to set up your business. You might have payroll. You might want to be looking at your financial reports, and don't forget about those quarterly taxes. It's a lot. And then when you need to make a financial decision or it's tax time, you start to realize that all of these things actually impact each other, and it can be very, very overwhelming. This is often when people start to say things like, I don't know what's going on in my business, or it feels like things are slipping through the cracks. So when we say that Collective is an all-in-one financial platform, what we mean is that we're taking all of these disparate parts of your business finances and we're bringing them under one roof and one platform. So everything is in one place and you have a team of experts who are helping you with some of the more painful parts of running your business, like doing your bookkeeping or filing your taxes. So I want to hear from all of you. What stresses you out the most when it comes to taxes? Sarah is going to launch a poll and let me know in the poll. Is it setting up your LLC or S Corp? Is it just preparing and filing your taxes? Is it having clean books, which often leads into preparing and filing your taxes? Is it finding financial advice? Or is it the long-term stuff like benefits and retirement planning? So I'll give everybody a couple minutes. And then, Sarah, I think we can close out the poll. All right, this is so interesting. 40% of you said preparation and filing, 30 said having clean books, 20 said setting up your LLC or S Corp, and 10 said finding skilled financial advice. Collective can help with all of this. And we'll talk more about that at the end of the webinar. But for now, I want to talk about taxes, specifically self-employed federal tax basics, because we need to understand how you're taxed now to understand how an S Corp can help you in the future. So in the United States, there are two types of taxes that self-employed people pay. And the first type of tax is income tax. Now, this is probably what you're already thinking about when you hear the word taxes, tax season, or April 15th. And in the United States, individuals are going to pay between 0 and 37% based on your tax bracket. Now, one important thing to know about income taxes is not a flat rate. It actually is a progressive system. So the first chunk of money that you earn is taxed at a certain rate, let's say 10%. The next chunk is taxed at 15, so on and so forth. So your tax bracket is actually what you cap out at, not what you're actually taxed at. So sometimes people will hear something like they're in a 24% tax bracket and they'll get really, really nervous and scared and think, oh my gosh, I'm paying 24% on all of the money I earn. It doesn't quite work like that. You're capping out at 24%. And this is a good thing. We like this type of tax system. It's called a progressive tax system because it ensures that we're not paying more in taxes. Now, income tax is something that pretty much everyone in the United States who has earned income is going to pay. So this isn't a tax that's specific to self-employed people. But the second type of tax that you pay is specific to self-employed people, and you can see by the name, it is called self-employment tax. So self-employment tax is a flat rate. So unlike income tax that has that whole progressive system that we just talked about, self-employment tax is a flat rate of 15.3%. And really what's happening when you pay self-employment tax is you are paying into your Social Security and Medicare. And you can see the breakdown there on the screen. Now, when you are an employee, so when you have a more traditional W-2 type of like employee job, you are still paying into your Social Security and Medicare. But the big difference is that your employer is paying half the bill. So you're only paying half of this 15.3%, and then you have some other party who is going to cover the other half. But when you're self-employed, the word self is in there, and there is no employer to cover the other half of the bill. And this means you're on the hook for the whole 15.3%. So this is why when people go from a employee type of job to being self-employed, they often feel like their tax bill has doubled. And when it comes to self-employment tax, that is the case because you are absorbing that entire cost of your Social Security and Medicare. Now, I want to show this in another way because I totally get that like percentages don't always work for people. So let's say that you're somebody that owes $15,000 in Social Security and Medicare.
Welcome to part 3 of
Ooh, someone started talking. I don't know what happened, but we're going to keep going. Let's say that you're somebody who owes $15,000. If you are an employee, you are only paying $7,500 of that, and your employer is going to pay the other half. If you're self-employed, you are paying the entire $15,000. And I don't know about you, but I definitely feel the impact of a $7,500 difference on my tax bill. So again, this is just to demonstrate to you why self-employed taxes are so expensive, that's really also being driven by self-employment tax. Okay, so now you know what types of taxes you're going to pay as a self-employed person. I want to talk a bit more about how you are actually taxed because a lot of people don't really understand the way that they're taxed. So here at the top, we have our revenue less our tax deductions. Revenue is just all the money you earn from selling your services. So think of this as money before expenses. And then, of course, you have your expenses or your tax deductions. When we take our revenue and we subtract our expenses, what's left is called net income. And if that's a positive number, it is called profit. You made more money than you spent. If it's a negative number, it's called a loss, and you spent more money than you made. Now, when you are self-employed, regardless of if you have a profit or a loss, that profit or loss is going to pass or flow through to your owner tax return. So this is a good thing. This is different than a corporation where the corporate entity is paying taxes at the corporate level. Your business itself is not paying taxes. Actually, everything is getting passed on to your personal tax return, which is we like this because it means you're avoiding double taxation. This is good. This is a good thing for us. You are then going to pay 15.3% self-employment tax on all of your business profits, and you are going to pay income tax. Now, income tax is assessed on all sorts of stuff. Basically, it's whatever you make from your business plus any other income in your life minus your personal adjustments or standard deduction, a bunch of other taxy things. The point here is that you will also pay income tax. Really, the key takeaway from this slide is that you are paying both of these taxes on your business profits. Okay, so let's talk a little bit more about what an S Corp is. But before we can really get into talking about an S Corp, we need to talk about this idea of legal structures because often there's a little bit of confusion about what an S Corp is. So a legal structure is a structure that is formed with the Secretary of State. The most common legal structures that you have probably heard of are an LLC and a corporation. The thing to know about a legal structure is it requires a formal organizational process with the state. It's usually going to be your Secretary of State. So if you have done nothing and have not filed any paperwork with your state, you most likely don't have a legal structure. You are probably just a sole proprietor, which is completely fine. There's nothing wrong with that. But if you have gone through a formal organizational process with the state where you have filed formation and organizational documents to create a legal structure like an LLC, which is probably what's going to be most common and appropriate for the people here today at the workshop, then you have a legal structure. And one of the things we like about a legal structure versus a sole proprietorship is that it creates a separation between the personal you and your business. Essentially, you will get some kind of liability protection that will protect your personal assets from any sort of business lawsuits or creditors. So this is why people want to form legal structures. This is why people like them. Now, when you have a legal structure, the trade-off is that there is more paperwork involved. You have to go through a formal organizational process that requires paperwork, but you also have to file annual reports, letting the state know who knows who managed the entity, and sometimes pay an annual fee. Keep in mind that legal structures are formed under your state. So there is not a single process that is consistent for every single state. Every single state will have a different process for formation, but also for what you need to file on an annual basis and what type of fees you need to pay. Okay, so we got it. We have this idea of a legal structure. Now, an S Corp is not a legal structure. An S Corp is a tax election for your legal structure. So the IRS decides how each business structure is taxed. So the IRS has made this great determination that if you are X business structure, you are going to be taxed as Y. And you can ask the IRS to change the way that you are taxed. Now, you can only do this if you have a legal structure. So if you are a sole proprietor, you cannot ask the IRS to change the way that you are taxed. You don't have that right. But if you're an LLC, for example, you can ask the IRS to change the way you're taxed. So one of the key things to keep in mind here when you're thinking about the S Corp is that the S Corp is for your legal structure. It means that if you are an LLC and you ask the IRS to tax you as an S Corp, you are still an LLC. You are really most accurately an LLC taxed as an S Corp. So another way I like to think about this, if you're more visual, is I like to think about it as like building a house. And what is the first thing you do when you build any house or structure? You lay the foundation. The legal structure, or let's just say like something like an LLC, is going to be that foundation or structure. And then what you build on top of that, your tax house, will be the S Corp tax election. So keep in mind two really key important things about the S Corp. One, you cannot ask the IRS to tax you as an S Corp if you are a sole proprietor. You're skipping a step, which is having a legal structure. And two, when you have a legal structure and you ask the IRS to tax that legal structure as an S Corp, you don't lose your legal structure. You keep your legal structure. You're just kind of like adding a tax accessory onto it. Okay, so why would you want to do this, right? Like, okay, so I guess I can ask the IRS to tax my LLC as an S Corp, but why? What's the point? How does this help me? Well, the biggest draw about an S Corp for folks is that S Corp owners don't pay self-employment tax on their business profits. Remember, it's that 15.3% that we looked at earlier that is making taxes really expensive for you. What's actually going to happen is that you are going to create an employer and employee relationship between yourself and your business. It's a little meta. You have to think about yourself as two people now. And your business self is going to be required to pay your personal self a reasonable compensation through payroll. In other words, you are going to receive a salary through your business as an employee. Now, here's the thing. Just like any other employer-employee relationship, your wages are subject to payroll tax. It's 15.3%. This probably sounds familiar because it's the same amount as self-employment tax, right? Basically, it's the same situation that any other employer-employee relationship has. The employer, your S Corp, is going to foot half of the bill, and then you, the personal you, is going to foot the other half of the bill. But what's important here is to keep in mind only your wages are subject to 15.3%. Now, I know that might feel a little vague. We're going to go through some slides to really like drive that point home. So don't worry if you're still like trying to like wrap your head around this. We have other ways to show how this is all going to work. Your S Corp profit and your employee wages are both going to become part of your personal income, and you're going to pay income tax on both. So you're combining the two. Okay, let's go through how an S Corp is taxed because it'll start to make more sense, and then we'll go through an example of how the S Corp helps to save you money. I am not going to go back through this slide. It's just to refresh our memories of how a sole proprietor is taxed. And a single member LLC is taxed exactly the same way as a sole proprietor. So this is just a refresher so we remember. Let's talk about S Corp taxation. Here at the top, we have the S Corp revenue. Remember, just the money you're earning from selling your services. Now we still have those expenses, but we have something new now, which is your owner salary. Because your owner salary becomes an expense, a tax deductible expense of your business. Now, on that salary, you're paying that 15.3% in taxes. Those Social Security and Medicare taxes, they have a different name in this scenario because accounting is weird like that, and there are different names for the same thing. But essentially, 15.3% for Social Security and Medicare. What we do now is we take your revenue, we subtract your expenses, right? Just your normal operating expenses. We subtract your salary. We subtract half of these payroll taxes. What is left is your profit or loss. Now, here's what we like. Just like being a sole proprietor, your profits or loss are going to pass through to your owner tax return. you still get to avoid double taxation, which is awesome, right? So this is really a tax structure that is set up to benefit small business owners. So your profit or loss is going to pass through to your owner tax return. And then your owner's salary is also going to get reported via a W-2 on your tax return. So those two become combined into your taxable income. And then you're going to pay income tax because, like I said earlier, pretty much if you have earned income in the US, you're going to pay income tax. Okay, so you might be looking at this and thinking to yourself, I kind of get it. How am I saving money? So let's look at that together. Here is an example of somebody who has $160,000 in profit. Now, when they are like a sole proprietor, a single member LLC without the S tax election, they cannot pay themselves an owner wage. But if they are an LLC taxed as an S Corp, let's say they pay themselves $60,000 in owner salary. What is subject to that 15.3% is $60,000. As the sole proprietor, what is subject to that 15.3%? It's all of the business profits. So it's $160,000. So this line here is really what's driving the tax savings of the S Corp, because with less earnings subject to 15.3%, you are going to owe less money in taxes. It's math at this point, right? It just becomes a mathematical exercise. So in this example, the difference is about $15,000 just by leveraging the S Corp tax structure. Now, people usually really like this total tax line because they're like, yay, $15,000 in savings. But I actually find the last two lines really, really interesting. So pass-through profit, remember, as a sole proprietor, everything's just going whoop all the way down to your owner tax return. So it's 160K. With the S Corp, why is it 100K and not 60K? Because remember, your owner wage is a tax deductible expense, so it's going to lower the profit. But the last line is taxable personal income, and that's 160. Why is that for the S Corp? Because that owner wage is still becoming your personal income. It's being reported to you on a W-2. So the big TLDR here is that as an S Corp, you as an individual are still earning about the same amount of money, but you're saving money on taxes. Okay, so this is the part in the webinar where people are usually very excited and they're like, woohoo, the only thing I don't understand is how to pay myself. So let's talk about this idea of reasonable compensation. Why are we using this kind of boring term called reasonable compensation? It's because it's what the IRS uses. And unfortunately, there is no set standard for reasonable compensation. It's what's considered a facts and circumstances argument. This means that you usually want to use collective or a tax professional to help you set this. Why? Because your salary is a tax strategy. A lot of people, when they become an S Corp, think about their salary as, ooh, it's going to be so cool to get this amount of a paycheck from my business. Or they think about it as, well, these are my personal living expenses, so this is what my salary should be. No, your salary should be looked at objectively just as a tax strategy. So what you're really trying to do is strike the balance between your tax savings and being within the rules of the IRS, which is why I love this graphic that we have here. If you were to slide this slider all the way up and pay yourself all of your profit via salary, well, the IRS would love you because they're getting more taxes, but you would have no tax savings. You're just replicating the tax structure of the sole proprietorship. Now, let's say you did the opposite and you slid it all the way down and you didn't pay yourself anything. Well, you would have incredible tax savings, but you would also be outside of the rules of the IRS. So what you're really trying to do is leverage the tax structure. Now, this can sound scary for people because they're like, but wait, I need to live off of my business. So if you're telling me that I can't take a full salary from my business of what I need to live on, this isn't going to work for me. When you are an S Corp, you can take distributions at any time. So what most S Corp owners do, and what I did when I was self-employed and had an S Corp, is I had, like, let's say this is how much I need to live off of. My salary got me here. And then what I did is the same day that my payroll ran and deposited into my personal account, I had a transfer from my business that made up the rest. And you can do that at any point and there's no tax implications. So again, that is why we can say and really look at the salary as a tax strategy, because it doesn't actually won't impact your personal financial situation as long as you're taking those distributions to offset it. Okay, so how do you know if it's best for you to do an S Corp or to become an LLC or stay a sole proprietor? So if you are a new to business with very little earnings, then it doesn't make sense to do the S Corp. The threshold that we use here at Collective is that if you earn less than $60,000 in self-employed profit a year, then an S Corp really doesn't make sense for you. And the reason for that is that with the S Corp, there's more complexity when it comes to running your business. You'll have to do things like you have to run payroll. That's a big business complexity. Your accounting will get more complex because you're running payroll. You have to file a business tax return specifically for the S Corp. So there's more costs involved with running the S Corp. Now, what we have found is that over $60,000, the tax savings will start to significantly outweigh the cost of the S Corp maintenance. But under that, you may get a little bit of tax savings, but when you start to think about all the other costs you're going to incur, it's not really worth inviting that type of complexity into your business. So S Corp is best for those really who are earning more than $60,000 in profit per year. The S Corp does have some additional benefits, like there are certain types of retirement plans that you can open as an S Corp owner that will help you maximize your retirement savings. But really, if you're thinking about it from a purely tax saving standpoint, if you earn more than $60,000 in profit per year, then it's a good time to start considering an S Corp. Now, the one other thing I want to mention is that an S Corp is best for those who have enough cash flow to make regular payroll runs. It doesn't mean that you have to like pick a salary January 1st and stick with it and the IRS is going to check on you. I don't mean that. I mean being able to run your payroll consistently. Why? Because you don't want to get to the end of the year, like November, have run zero payroll and realize that you need to do a $60,000 payroll run to stay in compliance with the IRS. That's really hard on your cash flow. So it's more about like, will you be able to keep up with the best practice of running payroll on a regular and consistent basis? Okay, so I want to talk a little bit about how Collective can make setting up and running an S Corp easy for you so you can get that tax savings, but you kind of get off the hook with all the complex stuff I was talking about earlier. Okay, so what do we do? S Corp setup. So if you are a sole proprietor and you don't already have an LLC, Collective will set up the LLC for you. If you do already have an LLC, then we will go ahead and get that S Corp election filed for you. Basically, we will do all the paperwork with the IRS to get you the federal tax designation of the S Corp. And typically that federal tax designation will flow through to your state taxes as well. Once you have your LLC and your S Corp set up, we will then take over your monthly bookkeeping. That's right. You no longer need to do your own bookkeeping. We will take all that work off your plate for you. We also will file business and personal tax returns. So your business tax return is included in a collective membership in your collective membership cost at no additional fee. So it's that S Corp tax return. But we also have a partner that we work with for your personal tax returns. It is an additional fee, but what's really nice is it's all in one platform. So you can log into your collective dashboard, you can fill out your business and personal tax organizer all in one place. And then our partner will handle the filing and preparation. And so everything is really seamless for you. We also have embedded payroll in our platform. So again, the idea here is that you can just log into one place and say, great, Collective is taking care of my bookkeeping. I need to run my salary. I just press a button here. I put it on autopilot, and that's all included in one membership and one platform. Every quarter, we send you quarterly tax estimates and remind you that you need to pay your quarterly taxes. So you'll receive that from us. We also give you S Corp compensation guidance. We just talked about that, right? So we talked a little bit about that needs to be a tax strategy. And then we do have support for some licensed professionals. I don't think that really applies for this group, but that is something that we support. We work with sole proprietors. We work with single member LLCs or PLLCs. We work with LLCs or PLLCs who already have the S Corp tax election. So we really work with everybody from every, stage of business. If you're a sole proprietor and you're like, I don't even have an LLC, I have nothing, we can support you. If you already have an LLC, then we can support you well. If you are an LLC and you have the S Corp tax election and you watch this webinar and you're like, I don't know what I'm doing with this thing, I need some help, we can help you as well. One thing I do want to note though is we only work with folks who are self-employed, earning more than $60,000 in profits per year. Why is that? Because we have a lot of integrity around what we do, and we don't just want to give out S Corps for folks that it's really not going to be beneficial for their business. This really needs to be the right tax strategy for your business. And if it's not right now, that's totally fine. You can wait and do it later down the road when you're at that 60K threshold. But for us, we want to be sure what we're supporting people with really does make sense for their business. Okay, so how much does it cost? Collective has a monthly membership fee of $349 a month. That includes the LLC setup, the S Corp setup, the monthly bookkeeping, the payroll tools, the business tax return. You have a support team you can message, supports annual compliance reminders. There's a lot in here that this supports, and it also includes a one-time and we also have a one-time onboarding fee. But I have a very exciting offer for all of you Squarespace folks, because we are partnering to offer Circle members an exclusive discount. If you use the code CIRCLE at checkout, you will receive 50% off your first 3 months, which is a $525 value. And I gotta say, getting that plus the tax savings, it's pretty good. It's pretty good. If I was self-employed, I'd be doing this again in a heartbeat. So again, Circle at checkout, 50% off your first 3 months. It's a really great offer that we don't offer very often, but we love our Squarespace friends so much that we want to extend this to you. So what's next? What do we do now? If you think Collective is a good fit, or even if you're kind of questioning about the S Corp, you're still not sure, you're wondering, is this right for your business? We're going to want to invite you to schedule a call with one of our advisors. It's completely free, and it's an opportunity for you to talk with somebody specifically about your business. And what I love about this is that I don't know all the nuances of your business. I can give you general information. I can answer your Q&As, but I can't spend 20 minutes with you or 25 minutes with you right now talking about your business. Our advisors can. And this is a great way to chat with an advisor, talk about your business, see if the S Corp is a good fit for you, if it makes sense, and see if Collective is a good fit. So highly, highly recommend taking us up on this offer, especially as we're almost to the end of the year. This is a great thing to start thinking about for 2025 and what this could look like for your 2025 tax season. It's honestly one of the best times of years to start thinking about these things and making these types of decisions. So with that, I'm going to pull up the Q&A, and I am going to answer a few Q&A questions. If I can get the Q&A to show. Uh-oh. Give me 1 second. I have lost the Zoom screen. This is the hard part about having 2 monitors. Where did it go? There it is. Okay. So please put your questions in the Q&A. We have about 10 minutes, and I love to answer questions. So I'll start with anonymous attendee. If you're new to business as an LLC and don't turn a profit, what happens when you file taxes? This is a great question. So if you are taking a loss, so let's say that you are new to business and you have a lot of startup expenses and you have, a loss in your business, that still flows through to your personal tax return. So this is where I said, regardless if you have a profit or a loss, both are going to flow back down and through into your personal tax return, which sometimes can be a nice thing because it may offset other income that you have. So the loss will flow through, and there's nothing to tax, right? The IRS doesn't tax losses. So you won't be paying any taxes on the loss. And actually, if you have other forms of income, it may offset some of that income and lower your taxes. Okay, we did that one. Andrea says, you said that if you paid yourself zero, you would have the most tax savings. But what I've been understanding is that having a salary marked as an expense is what saves taxes. Can you walk me through that? Yeah, so it's not actually having the salary taxed as an expense. I'm trying to find the slide so I can like walk back through it. Here it is. So what is driving the tax savings is not that the salary is marked as an expense. What is driving the tax savings is what money is subject to the 15.3%, right? That's Social Security and Medicare taxes. Social Security and Medicare tax. So in this case example, the money that is subject to 15.3% as the S Corp is always going to be your employee wages, which is $60,000. Now, in this example, it's all of the pass-through profit, which is $160,000. So it's actually being driven by the money that's subject to those taxes, not the fact that this will lower your overall profits. That can have an impact on your taxes. So I don't want to say it has no impact because there can be some impact, but it's not actually what's driving this $15,000 number. Now, when I said that this is zero, so let's say that you paid yourself nothing. Well, then you would have this line would be zero, right? Like in this case, if you paid yourself $0, your total tax would be zero, right? Besides income tax, but your total Social Security and Medicare taxes would be zero, and this number would be $24,000. But of course, the IRS doesn't like that. They don't want you to pay yourself $0. That's actually really outside the rules of the IRS when it comes to the S Corp tax election. So, Andrea, I hope I answered that and that makes more sense. If it doesn't, just let me know and I'm happy to like review it again. Okay, Davey says, I've heard the timing is important. At what point in the year do you need to elect S Corp status? Does it cover the whole year? So yeah, so what I would say at this stage in the year, so where we are right now in the year, is that I would highly recommend, if you think this is the right thing for you, electing S Corp status for January 1st, 2025. Now you might be thinking, no, I want it for 2024. Why can't I have it for 2024? The reason is that in order to retroactively have S Corp tax status for like an entire year, you basically have to prove to the IRS that you have been operating as an S Corp the whole time, which is hard to do. But also, you have to do a giant payroll run, which most people don't have the cash on hand to do, right? Because if you're saying, no, I should be an S Corp for all of 2024, then the IRS is like, great, then you should have paid yourself for all of 2024. So it is, generally speaking, extremely difficult for people at this stage of the year, the last quarter of the year, to retroactively elect back. Now, because we're so late in the year, it's very easy right now to elect S Corp status for January 1st. Now, in general, so let's talk, so this is kind of like the right now situation, but you might be thinking, well, I'm not ready for it right now, but I think I might be ready for it down the road. If you're ready for it down the road, the official IRS thing is that you'll need to elect your S Corp status by March 15th of the following year for it to retroact to January 1st. We do have at Collective a special process where we can help sometimes retroactively elect S Corps. It's a case-by-case basis. So you really kind of have until March 15th of 2025 if you want the status for the whole year, because you can go backwards. As you get later in the year, it becomes harder and harder to retroactively elect, which is actually why this is a great time for this webinar, because you have 6 weeks until the close of the year. You have a lot of time to talk to a collective advisor, to really think about this and to make a more intentional decision about your business. Okay, Anonymous says, what about costs associated with bookkeeping software like QuickBooks? Are the bookkeeping platform costs built into the monthly membership? They are. So we actually have our own accounting platform that exists, accounting software that exists within your dashboard. Now, that being said, you don't actually need to use it because our bookkeepers are doing your bookkeeping for you, right? So you don't actually need to utilize the utilize it as bookkeeping software because you have bookkeepers. But what's really nice about the software is that you can go in there and you can run financial reports whenever you want. So it's kind of marrying, like, what's great about QuickBooks is that you have, it's sort of like you can go in and run reports and things, but what's not so great is that you have to do it yourself. It's marrying that, the good parts of something like QuickBooks, with the even better parts of outsourcing the actual bookkeeping to a team of experts who can handle that for you. But yeah, it's all inside the platform. Again, our whole thing is one login to run your business. It's like everything is inside one platform so that you're able to just go into one place and run your profit and loss statement or send an invoice. And there's no additional cost for that. So this 349 covers boop, 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 everything on this slide except for the personal tax return filing. That's the one service area that is an add-on. So everything else you see here, including all of the tools like running payroll, the payroll software, the monthly bookkeeping, the quarterly tax estimates, setting up your LLC and S Corp, that's all included in the 349. Okay, any other questions? No? Let's check the chat really quickly. I think great. Okay, well, thank you all so much. If there's no other questions, and we ended right on time, which is always amazing. Thank you all so much. Again, I highly, highly encourage you all to use the link that we have in the chat to schedule a call with one of our advisors and talk about what could be next for your business in 2025. Again, it is such a good time of year to be thinking about this. I know it feels far away and like you don't really need to think about this yet, but it really does it really does help to have these thoughts now and intentionality now so that you can really you have the peace of mind of going into the new year knowing exactly what you're doing about your tax strategy and situation. So I hope that I will see you all as collective members, and thank you so much for joining.